Welcome to Uncovering Trusts, the Edison Group podcast where we explore some of the most interesting investment trusts on the market. I'm your host, Salim Aben, and today I'm joined by Milosz Papst, Director of Investment Company Content at Edison, to discuss Baillie Gifford US Growth Trust, which trades under the ticker USA. Milosz, great to have you with us.
Thanks, Liam. Great to be here, as always.
So just to kick off the conversation today, for those listeners who may be less familiar with the trust, what is Baillie Gifford US Growth Trust and what is it trying to achieve?
Yeah, so Baillie Gifford US Growth Trust was launched in March 2018 and is listed on the main market of the London Stock Exchange. It is managed by Gary Robinson and Kirsty Gibson. Both are partners at Baillie Gifford, the Edinburgh-based investment management firm. The trust's objective is to produce long-term capital growth by investing predominantly in equities of companies that are incorporated, domiciled, or conduct a significant portion of their business in the United States. Its benchmark is the S&P 500 Total Return Index in sterling. Now, the managers are at heart bottom-up growth investors with a long-term horizon. They seek outlier businesses, that is, exceptional growth companies with huge addressable markets whose upside potential they see as, virtually unbounded. The investment process is centered on identifying these outliers and owning them long enough for the strengths of their business models and cultures to become the primary driver of the returns they generate.
That's great. And you touched there on the trust investment process and philosophy. What specifically are the managers looking for?
Philosophy rests on well-evidenced observation, which we've also mentioned during our recent podcast on the Scottish Mortgage Investment Trust, that the majority of equity market returns are generated by a very small number of exceptional companies. Gibson and Robinson are seeking businesses with deep competitive advantages, strong financial characteristics, and perhaps most distinctively, powerful corporate cultures, which they view as a vital indicator of long-term performance potential. Around 75% of portfolio holdings are run by their founders, which the managers consider a key signal of that cultural alignment. Now, their explicit return targets reflect this ambition. They seek listed companies capable of delivering at least 2.5 times returns over rolling 5-year periods, and private companies that can deliver 5-fold returns over the same time frame. They are trying to identify the, mega caps of tomorrow, rather than assemble, a broadly diversified index-like portfolio.
Sure. And private companies clearly seem to be a distinctive feature of this trust. Can you explain why the managers place such emphasis on them?
Yes, Liam. So it's arguably one of the most compelling aspects of the trust proposition. The trust can invest up to 50% of total assets in private companies at the time of investment. And this matters because US companies are increasingly choosing to stay private for longer. According to Baillie Gifford's research in 2024, the median age of a venture capital-backed private company was 10.7 years, compared with 6.9 years in 2014, as businesses choose to avoid onerous reporting obligations and, the short-termism of public markets. The practical implication is that the listed equity universe no longer offers the full spectrum of growth opportunities it once did. Baillie Gifford's well-established position in private markets is a genuine competitive advantage here. Since 2012, it has made investments of more than $10 billion in over 150 private companies, and I believe has built a reputation as the investor of choice for companies with public listing ambitions. A recent example was the trust's participation in the $13 billion late-stage fundraising by Anthropic, the AI developer. As at the end of March 2026, private company exposure stood at 44.1% of total assets, spread across 28 companies. However, I would note that the historical long-term average share of private companies in the trust portfolio in a healthier IPO market was around 20 to 30%.
Okay, great. And perhaps could you discuss for us what has portfolio activity looked like over the past year or so?
Yes, sure. There has been, meaningful activity on the private company side. In addition to Anthropic, new positions added during the financial year to May 2025 included Rippling, a workforce management system using automation to help fast-growing companies scale. Runaway AI, a generative AI video platform serving individual creators through to professional studios. and Cosm, an immersive entertainment company creating pioneering 360-degree shared reality experiences through massive LED domes in US cities, partnering with the NBA and others. On the listed side, new holdings included DraftKings, the leading US online sports betting company, Lineage, the global leader in temperature-controlled warehousing, and Shark Ninja, a manufacturer of high-quality consumer appliances with scope for significant international expansion. The trust also participated in the IPOs of Circle Internet, the issuer of a digital currency pegged to the US dollar, and Figma, the web-based collaborative design platform that has penetrated 80% of Forbes 2000 companies. On disposals, the managers closed the long-standing position in Roku after concluding that competition was intensifying and profitability remained elusive, particularly given additional digital advertising exposure from purchasing AppLovin. They also exited Airbnb in August 2025, having held it since before its IPO in 2019. The position had more than doubled investors' money, but with competition intensifying and the company maturing, other opportunities offered a more compelling outlook.
I understand that the managers have also evolved the portfolio construction approach. Can you perhaps explain now what's changed over time and why it's changed?
Yes, this is an important development. The managers were disappointed with the trust's 3- and 5-year performance, hit hard by the surge in growth stocks during the COVID period and their subsequent sharp derating as interest rates rose steeply in 2022. In response, they have implemented a set of portfolio construction enhancements and guide rails. Most notably, they now automatically retest the upside case for all listed stocks once they cross the 2.5 times return threshold I've mentioned before, regardless of the time frame. A stock that has already delivered that return must demonstrate it can still meet the bar from its current price to justify remaining in the portfolio. This retest covers factors such as resilience, cash generation, demand driver correlation, and stress testing of internal narratives. More broadly, the managers are monitoring the overall shape of the portfolio more carefully, ensuring an appropriate balance of growth styles, business maturities, and structural growth drivers. For private companies where applying mechanical rules is more difficult, the team is being more selective and favoring businesses with greater diversity of revenue sources while being particularly mindful of not building up excessive consumer sector exposure.
So we discussed private companies as a distinctive feature of the trust. It seems AI is also central to the trust investment case at the moment. How are managers thinking about the opportunities associated with artificial intelligence?
Indeed, AI is central to the investment case, but the manager's framing is quite nuanced, I would say. They are not buying businesses simply because they can be labeled as AI plays. Rather, they are looking at where AI strengthens existing competitive advantages and where it creates new control points in the technology stack. NVIDIA is the clearest example of the first category. It remains, of course, central to the compute layer underpinning serious AI workloads. Meta is another, because AI can reinforce advantages it already has in distribution, data, and monetization. Amazon is strategically well placed through AWS and its growing chip capabilities. And then there are businesses such as Cloudflare and Databricks, which provide important infrastructure and data tools that make enterprise AI possible. The second category is earlier stage companies where the upside could be much more asymmetric. Anthropic and Runaway AI fit that description. The managers think these kinds of businesses could occupy very valuable control points if AI adoption keeps broadening. Now, beyond AI, they also remain excited by areas such as digital infrastructure more broadly and parts of healthcare where better tools, data, and scientific productivity could unlock very attractive growth opportunities.
That's great, thank you. And just could we perhaps look at some of the trust's largest portfolio positions in more detail?
Yes, of course. At the end of March 2026, SpaceX was the largest holding at 14.9% of total assets. SpaceX has been held in the trust since 2018, and it has been a remarkable performer. Its reusable rocket technology has, as many know, transformed the economics of space launch, and Starlink, its satellite internet service, now has more than 6 million subscribers in 140 countries, with a vast addressable market still to be tapped. The second largest holding is Stripe at 8.5% of total assets. Stripe is a private payments technology company whose ambition is to grow the GDP of the internet, so to speak. And importantly, it achieved profitability during the past year, a milestone the managers regard as a significant validation of the business model. Amazon follows at 4.4%, then Nvidia at 4.3%, and Meta Platforms at 3.8%. The rest of the top 10 are Anthropic, Databricks, Netflix, Cloudflare, and Billion to One, a diagnostics company using next-generation sequencing to transform prenatal testing. In aggregate, the top 10 account for 51.3% of total assets. At sector level, information technology is the largest allocation at around 36% of total assets, followed by industrials at just under 20%, consumer discretionary at 14%, healthcare at 13%, and communication services at just over 9%. And the trust has no energy or utilities exposure. What's important is that the active share versus the S&P 500 is 85%, which I think underscores just how differentiated the portfolio is from its benchmark.
Now, turning to a very important topic for our listeners, could you perhaps give an overview of how the trust has performed over time?
Well, the recent picture is encouraging. In the year to the end of March 2026, the trust delivered an NAV total return of 20.1%, which is well ahead of the S&P 500 benchmark total return of 15.3%. The share price total return was a strong of 27.7%, leading to a narrower discount. Now, over 3 years, the cumulative NAV total return was 64.2% against the benchmark's 55.3%, and the share price is 98.2% total return. In the financial year to end August 2025, the NAV returned 31.6%, and the share price is 37.6% against the benchmark's 12.7%. So, a standout year for the trust. Key drivers included SpaceX, Cloudflare, and Shopify. Shopify illustrates what the managers are targeting. A founder-led business with a strong culture, having evolved from a simple e-commerce platform into a sophisticated merchant services provider, now with an AI-driven sidekick assistant automating significant portions of merchant operations. Netflix was another strong contributor, entering what the managers described as its fourth act, that is expanding into advertising, live events, and gaming, building a flywheel of momentum well beyond its existing 300 million subscribers. To provide a balanced perspective, the 5-year cumulative NAV return to March 2026 was just 1.3% against the benchmark's 84.9%. The managers are upfront about this, attributing it to the outperformance of growth stocks during COVID, followed by sharp valuation compression as rates rose rapidly in 2022, but particularly challenging conditions for a high-growth, long-duration portfolio. The portfolio construction enhancements were introduced specifically to improve resilience to such conditions in the future. Since inception in March 2018 until the end of March 2026, the NAV total return was 207.4% against the benchmark's 208.2%, so broadly in line over the full period.
Following from that, are there any other financial metrics or fees that you'd like to discuss?
Yes, at the end of March, total assets were £871.2 million and net gearing was 4%, which is conservative relative to the board's typical target of 10 to 20% of NAV, and the maximum permitted 30% of NAV on listed securities. The ongoing charges ratio was 0.72% for the financial year to May 2025, comparing very favorably with the AAC North America peer group average of around 1%. There are no performance fees, and the trust does not pay a dividend, consistent with its focus on long-term capital growth.
Before we wrap up today, Milosz, could you briefly summarize why an investor might consider Baillie Gifford US Growth Trust?
Sure. The trust offers access to a portfolio of exceptional US growth companies, both listed and private, managed by a team with genuine long-term conviction. Several things stand out. First, the US remains the innovation capital of the world, with the capacity to lead AI-driven transformation at scale. Second, the trust's private company access, 44% of assets in late-stage private companies, backed by Baillie Gifford's formidable reputation in that space, is not easily replicated elsewhere in the closed-ended fund universe. And third, recent performance has been strong, with NAV ahead of the benchmark over both 1 and 3 years, while the portfolio construction enhancements should improve resilience to future volatility. And fourth, an ongoing charge of 0.72% provides an attractive cost proposition for long-term investors. But investors should nonetheless be mindful about the risks. This is, a concentrated, high-growth, long-duration portfolio that can be volatile, and the significant private company exposure adds valuation complexity and lower liquidity. So this is very much a trust for patient investors with a long-term horizon.
That's great. Milosz, thank you very much for your time today.
My pleasure, Liam. Always a fascinating trust to discuss.
You've been listening to Uncovering Trusts, a podcast by Edison Group. For more information on Baillie Gifford US Growth Trust and other investment companies we cover, please visit www.edisongroup.com.